What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we're going to be looking at the AI cloud computing company CoreWeave after the recent sell-off in all major tech names, and CoreWeave especially having an even larger sell-off. I believe it's important for us to take a look at some fundamental and technicals for the name, as this could be a good entry point for investors to add beta to their portfolios. As always, this is not investment or financial advice and is solely for entertainment purposes. So let's dive right in here to the past 1 year performance there in the bottom snippet of CoreWeave shares. You can see in that time frame, shares of CoreWeave underperformed the NASDAQ by almost 61% over the past 12 months, also trailing on a year-to-date basis as well, with the NASDAQ being up 10%, whereas CoreWeave shares are up only 7.5%, give or take. Really selling off over the past month. That does coincide with the larger tech sell-off and chip sell-off that we've been experiencing, which does present some good buying opportunities. You can see in that top graph there, shares are still trading above where they IPO'd. That's the 2-year chart that we're looking at. That green line is that 50-day moving average, still above the 200-day moving average in the orange line, ever so slightly, yet we're seeing shares trading below both averages, with the RSI indicating an oversold valuation. There may be a short-term bounce in the name, and we can also see that shares in that bottom snippet are trading at or almost their 52-week low. Now, there's a few key items that I want to point our attention to. Really, the major point here is that earnings per share. You can see a significant earnings per share decline through 2026. And that's because of a variety of factors. One, CoreWeave has issued a lot of debt, which has higher interest charges, which is compressing margins. Along with that, they're taking that debt and investing heavily internally so that they're able to invest in better infrastructure and better product output to meet their ever-growing demand. So inevitably, that is going to compress earnings, that is going to compress margins, which we do see on those profitability metrics, gross margins at 34.8%, yet being compressed on the net margin side to almost negative 26%. Margins have come down over the past really 6 quarters for CoreWeave because of that heavy investment internally. That investment, I do personally believe, is warranted. You are having that demand backlog. You're having a significant revenue backlog as well. And if you're not able to meet that demand, well, you have one of two options: either invest internally to have better product output or lose that revenue backlog in its entirety. So I do believe CoreWeave is allocating their capital efficiently. And what we like to see is that they're issuing debt, not issuing equity to dilute shareholders. Right now, that isn't in the foreseeable future if you look at the post recent quarterly reports and management commentary. But I have to be honest, I wouldn't rule that out in the not so distant future. And when we look at that return on equity, really a significant decline, negative 40.7%. Again, heavy CapEx. You're not going to see and realize those returns so quickly. This is a long-term play. CoreWeave is a very early stage company, is in its early innings of growth. And we'll look at that compared to more established peers later on in the video. But we do see through 2027 that earnings per share going from negative $3.73 to negative $1.30 through fiscal year 2027. And we should see margins expand, earnings expand, and have true earnings report in future quarters. And when we look at those valuation metrics, obviously no earnings is going to produce no price to earnings ratio. But when we look at even the price to sales at 6.6 is not an overvaluation for the revenue backlog that CoreWeave has. And I will say that NVIDIA stock that a lot of people in the market are discussing. Now, there are 33 analysts who cover CoreWeave shares. They do have an average price target of $140.82, which does imply an 82.6% upside. The biggest bear has shares declining by more than half to $36 a share, with the biggest bull having shares appreciate almost 300% to $302 a share. And when we look at that top bar graph there, One, we're having a lower amount of analysts have a sell rating on CoreWeave shares. And when we look at that dotted line, which is the analyst price targets, and that solid blue line, which is the underlying CoreWeave share price, there has never been such a discrimination between where institutional and smart money believes the true value of CoreWeave shares should be priced at relative to where shares are trading in the market currently. So there will be some sort of convergence between analyst target prices and the actual underlying share price, whether that is shares appreciating, which I personally do believe will occur, or analysts cutting their price targets, which I don't believe is going to be the case, especially when you look at that dotted gray line. There you are seeing a slight uptick in most recent months. That is due to the fact a lot of analysts are revising upwards their price targets on CoreWeave. And for such a new company, profitability ratios are going to be very skewed, and in most cases should be reporting negative prints, especially through the heavy capex that CoreWeave is doing internally. We do see a steady gross margin ratio over the past 3 years. Those net margins have actually started to compress. You look at December of 2023, for example, of negative 259.3% net margins to year-end 2025 to negative 22.7% net margin. That is from the early stages that CoreWeave had to invest even more heavily to get really off the ground and land that big NVIDIA partnership back in the day, which has established a foundation to hopefully expanding partnerships outside of NVIDIA. And we also look at those returns on assets, equity, total capital, and invested capital. You should see, and wouldn't be surprised to continue to see, negative prints on those returns just due to the heavy capex that management is executing on, at least through 2027. And this is what I'm talking about here. You're looking at companies that are more established in the Oracle, Microsoft, and Amazon space, healthy margins of almost 70% in Microsoft's case, not having such a compression of gross to net margin. Mind you, these companies are also spending heavily. And today, I would still, even through this most recent tech sell-off, would like to own Oracle, Microsoft, and Amazon and have them at larger positions than CoreWeave. I believe CoreWeave could be a good beta producer in portfolios by just being a small position and having that over the long term to let management play out their strategy and execute for shareholders, hopefully producing returns for shareholders over the long term. But again, you can see the potential of where CoreWeave can get to that Oracle, Microsoft, and then Amazon space in those cloud computing segments. And I keep mentioning that CoreWeave is investing heavily internally due to the demand surge and revenue backlog. A good comparison to this has been Microsoft Azure. Really in Q1 and Q2 of 2026, Microsoft reported on their Azure business that they were diverting a lot of revenue internally, and we explored this in previous videos on my page, which I do encourage you to go take a look at. But diverting a lot of that revenue internally and a lot of that spending really compressed revenues and margins for the Azure business of Microsoft. But Microsoft has a $650+ billion backlog, and if they're not investing into the expansion, the productivity, the efficiencies that need to come with having a supply output to meet demand, Azure wouldn't be the company that it is today. And that's been an overhang on Microsoft stock and really has been the overhang on CoreWeave as well. Those businesses are very similar, not the same, I will mention. But this is not just a CoreWeave issue, not even a Microsoft Azure issue, but this is a sector issue where demand is really outpacing supply, which leads to diverting resources internally to meet this demand surge. And it's really important for these smaller, new established companies to have good sales and revenues, to have those cash flows in order to invest internally and have these heavy capex dollars for companies. And we see that with CoreWeave. Look at that 10-year trend chart Really, it's a very new established company, started in 2017, hasn't even had a 10-year anniversary yet as a company to begin with, yet we're seeing very rapid growth over the past 3 years and over the trailing 12 months. So revenue and sales are there to support the heavy investment and CapEx that CoreWeave is implementing, along with the issuing of debt. Again, healthy to see that, rather than having equity being issued and diluting existing shareholders. Those earnings per share we should continue to see decline over the coming quarters, but again, through fiscal year 2027, we should start to see an earnings per share expansion and hopefully have positive EPS starting in 2028, according to management's plan. Let's see how that plan pans out. But it's also important, with all this debt that they have on their balance sheet, their liquidity and credit analysis ratios, really the current ratio, quick and cash ratios, have all been coming down through 2023. This is due to the higher interest coverage that CoreWeave is experiencing, and you can see that on the credit analysis tab, those numbers and values increasing over the years. And this is a good visual for us to see that solid blue line is the cash and short-term investments on the balance sheet. That yellow bar graph is the interest and debt servicing on that debt CoreWeave has issued and also taken on through loans. We don't like to see interest coverage surpassing cash. I believe this is just going to be a short-term issue, which CoreWeave is able to sustain due to their revenue backlog and sales forecasts as well. But again, I don't believe management has overextended itself, and we would rather right now, as shareholders, see that debt being issued rather than equity to fund this growth. And this is just a geographical breakdown of CoreWeave's revenue. I'm not too concerned with the bulk of that revenue coming from the US. The concern is the bulk of that revenue coming from NVIDIA alone. A lot of these hyperscalers and the biggest spenders are based in the US, whether you're looking at the Metas, the Googles, the Amazons, the Microsofts, and so forth. Having that US revenue for CoreWeave is not an issue. It's the expansion on a more Main Street level, expanding to different businesses. And I will also say in the EU and in Asia as well, in the India region, that is investing heavily in technology, productivity, and having a lot of their own AI-based companies, I think will be a good leg of growth in future quarters and future years for CoreWeave, as they are the best in class of what they do. And you can see that with the companies really trusting CoreWeave product and services. Now, I believe it's important for us to take a look at a few bull and bear cases for CoreWeave. And I keep talking about this massive revenue backlog that management continuously is reporting and telling the street. This backlog is exceeding $99 billion, bolstered by multi-billion-dollar commitments from major tech players like Meta and Anthropic. This provides significant visibility into future earnings. Now, this is either a positive or a negative, depending on how you look at it, is this NVIDIA partnership. This is a unique partnership that provides early access to NVIDIA's latest GPU architecture, the ever so talked about Blackwell, which creates a competitive moat. The first mover advantage allows CoreWeave to command pricing power even in a high demand, supply constrained environment. On the flip side, and really management, the street, nor myself see this in the short term or even in the foreseeable future, is NVIDIA backing out of that partnership. Right now, there is a heavy reliance from NVIDIA on CoreWeave and vice versa. NVIDIA is also heavily invested into CoreWeave, so there is that NVIDIA put, I guess we can call it, that will ensure the company stays afloat, or potentially even assumed by NVIDIA in the future. Now, the company is successfully transitioning from being a purely training provider to a robust inference platform. Since inference workloads are more durable and predictable than one-off model training, this is expected to stabilize and extend revenue cycles. And unlike some of the commodity cloud producers, CoreWeave has shown an ability to pass through component cost inflation to its customers via its long-term contracts. helping it to insulate margins against hardware price increases that are forecasted in the next 12 to 24 months. And just the bull case that we've been talking about throughout this video is that margin pressure and that heavy debt load that management has taken on. You see that big revenue backlog of that 99 billion. Right now, CoreWeave doesn't have the ability to service all of that demand, so they are investing heavily in order to meet those demands and have an even bigger revenue generator in future quarters and have an even bigger backlog as the company grows just through the law of large numbers. Once this heavy capex internally is completed, they should see a realization of those investments and an expansion of margins in future quarters. But hey, let's see, time will tell. Again, this is a good beta generator in portfolios. Shouldn't be a large position. This is not investment or financial advice, but I do believe this smaller position, longer term for investors, they will be rewarded. I do appreciate you guys making it to the end of the video. Please do hit that like and subscribe button. Take a look at some other videos on the channel and stay tuned for the next video.